this is Demel Gonzalez of Heartwood Financial Services. Hey, welcome for our latest edition of the market update and outlook for the month of January. It's been a pretty eventful one. You've probably seen the market take a little bit of a hit here in the month of January. So what I want to dig into is what is going on and why is the Fed doing what they're doing, and let's really dig into what is going on with inflation. So thanks for tuning in. I hope you guys enjoy it. If you're first time here, welcome. Go ahead and hit the like button, subscribe. If you've been here before, welcome back. I hope you guys enjoy it. So the title of this market update is High Inflation or Weaker Economy. So this is the conundrum that the Fed finds itself in. They're seeing inflation spike and they're concerned and they want to make sure that they can slow things down, but they don't want to slow things down too much and hurt the economy. So this is the big catalyst of what we've seen here in the last actually few months, but really spike a little bit more in the volatility in the month of January. So let's dive right into it. Okay, as always, we like to start with our asset class returns. You can see here by the chart that it was not a good month for the month of January. Still doing great for a one-year period by the green that you can see here. But January was definitely a slowdown, and we'll talk a lot more about it in the next few slides about what's going on and what the catalyst was. But just real quick, we got the large cap down about 5% for the month. Small cap down about 7%. Real estate actually down a little bit more. They've been the big leaders, down 8.5. You can see how they've done the best over a 12-month period. Developed market international stocks down 5.3. Emerging markets, interesting. Seems like they're holding up a little bit better, down barely 1%. The high quality fixed income down about 1.88%. And we'll be talking a little bit about that because it's related to this, of course, with interest rates. High yield down a little bit more, minus 3.55. And commodities, look at that, up 8.68%. We'll dig into that as well. So this is like the quick recap, but we'll dig into a little bit of what's going on and why some of these areas are doing what they're doing. All right, so first and foremost, the big piece of news has really been what the Fed has been up to, really not just this month, but the last few months. And it's just really reverberating more and more in the stock market. It seems like every time Jay Powell opens his mouth, the market goes down. And one of the things I wanted to highlight here, because they're doing three things. They're tapering, they're raising rates, and they're also talking about reducing the balance sheet. We've talked a little bit about this in the last few videos. But this one I want to highlight the rate hikes. You can see here how the Fed had lowered interest rates basically to zero during the pandemic. And now that, two things, we're seeing the economy start to strengthen, employment numbers starting to come out a little bit better, but also inflation really heat up. They're getting to the point where they feel like they need to raise interest rates. Here you can see the Fed funds futures, which is actually a market that bets on, where the Fed is and how much the Fed is going to raise rates. Believe it or not, that exists. Is up above 2% over the next few years. And so there's most likely going to be some rate hikes this year, and that could slow things down, especially the stocks and the bonds that tend to be a little bit more sensitive to interest rates. So this is one of the biggest catalysts of what we're seeing right now. So over the last couple months, I've been talking about how we have been transitioning from risks of COVID to more of the risks of the Fed. And this is just to kind of reiterate that. This chart here on the left, you can see how the cases spiked really big, have been coming down, but mainly the death rate has been pretty low. Even though we've had tons more cases than we did with Delta, the death rate is about the same. And per 100, you could see that the mortality rate's also going down. All good things. So we're kind of transitioning away from COVID being the number one thing to the Fed. Now, if you've been watching the news, you've also seen that we've been talking a lot about Ukraine. And this is a geopolitical risk that's out there. Right now, it's not something that we're overly concerned about, but it is just an additional risk, kind of a headwind to the stock market every time, there's more tanks moving or we're moving people out of embassies. The market has some jitters. The biggest impact that this is currently having is on energy prices. As you all know, Russia, they produce a lot of energy. They deliver a lot of natural gas and oil to Europe and really the whole world. So this has been affecting energy prices. If you filled up your gas tank here in the last few weeks, you've probably seen a spike. A lot of that has to do with inflation, but also because of this situation in Ukraine. Now, I also want to be balanced and show you that not everything is bad out there. We talked about some of the risks with the Fed and COVID and Ukraine. But, it's earnings season right now, and earnings have actually been coming out pretty good. Now, again, when you go from earnings that were massive last year, because the year before that, they were horrible, and then you go to a more normal year, yes, it's going to look like earnings growth is slowing down. But what you can see here by this chart, year over year, this is 2019, 2020, 2021, 2022, you can see that the estimates, this is a chart by FactSet, shows that the estimates are still for earnings to continue to grow. Maybe not at the same rate, but they're still going to grow. And it's very, very rare to see earnings go up and employment stay low and have a recession. So in other words, what we're experiencing right now with the market is most likely just a correction, digesting this news by the Fed, and a little bit of the jitters maybe with what's going on with Russia. Now, just today's Friday when I filmed this, we had the latest jobs report, and it actually came out pretty good. It was surprising because some of the data from ADP, which is a private company, it actually looked pretty bad. It looked like we lost jobs. But the BLS, which is the government report, actually shows that we gained almost 500,000 jobs in the month of January. That's amazing. And they actually revised way up the one from December. So what I'm trying to say here is not everything is bleak. There's actually some great signs. We're looking at earnings that are good. Jobs are still strong. The economy looks very strong. And this is just another sign of this. All right, so let's dig into the outlook here. The main thing I want to talk about is inflation, and what happens to inflation is going to dictate what's going to happen to the Fed. And what the Fed does in accordance to inflation is going to have a dramatic effect on the stock market. Now, I want to show you one thing here. This is the inflation rate over the last few years, and there's a couple different measurements of it, but you can kind of see what the trend is, right? It was really low during the pandemic. It's taken a big spike here recently. When we calculate the CPI, that Consumer Price Index, which is basically what we use as inflation, you can see that that number has really started to go up around February, March of 2021. Okay, and when you calculate CPI, it's an annualized number looking at the past 12 months. So you see where I'm going here? These low inflation numbers are going to start rolling off here very, very soon, starting next month and then the month after that. So what I predict is going to happen is those 7+% CPI numbers that we were seeing, they were based on really low comps. Now the inflation rate comps are going to be higher. So you're going to see that growth in inflation is going to start to come down little by little by little. as they start to compare to these higher inflation numbers. Now, that doesn't mean that inflation's going down or that it's going back to this 2% range that the Fed was going for. That's probably not happening, but what's going to likely happen, it's going to plateau and start coming down to a more normal range. There is a measurement of inflation from the bond market that predicts that the 5-year break-even rate for inflation is probably more around 2.5% to 3%. So that's probably more realistic for long term rather than the 7% that we've been seeing. And so the reason I'm making such a big deal about this is, like I said at the beginning, if the Fed starts to see interest rates, or I should say inflation, start to plateau, maybe start coming down a little bit, they won't have to be as aggressive. And as soon as they start seeing some signs of hope with inflation, I think they're going to start backpedaling a little bit. All this aggressiveness with raising rates and reducing the balance sheet. And I think that could really be a big catalyst for the market to turn around. And remember, we have a backdrop where the economy is still pretty healthy and earnings are good. Okay, one more slide. Last one, I promise. So I wanted to talk a little bit about the investment implications of this inflation, because as we talked about, it's not going away right away. Maybe it'll start to go down a little bit, but it's still going to be high. And this chart here shows basically different decades and highlights these two here where we had a lot of inflation. And what I want to show you here, the blue is the contribution of total return for the S&P 500 of dividends. Okay, the gray is just the price appreciation. So you can see during these inflationary periods, which maybe we're starting to get into one again here in the 2020s, we shall see. It's more important than ever to have things that pay dividends, because potentially most of the returns are going to come from the dividends. And so the reason I bring this up is I want to emphasize that this is something I'm aware of. This is something I've been emphasizing in the portfolios. We're using lots of different dividend-oriented types of equities, in addition to commodities and all the traditional hedges for inflation, but also using dividend-oriented stocks. So that's very important. If you have any questions about this, give me a call, send me an email. Be happy to chat with you more about it. But I hope this was helpful, and we'll see you again soon.